So, so far we've seen a rejection and failure at the all-time high, right? So we got a false breakout. Now the market was quite overextended into the all-time high, so even like the pattern that was in play didn't really support a big breakout. Like if this same pattern happened on a smaller time frame, we would not be buying up here because the market went too far too quickly, and by the time it tries to break out, it's already so overextended that it makes it a risky play, right? But that being said, this is still a very bullish structure overall. It doesn't mean that the market has to now completely crash and burn or something. It's still a fairly bullish environment overall. The market is pulling back into essentially the top of this balance area that we broke out from, right? That's the area that's being tested right now. Like I showed you earlier with the Russell, it's pulling back into its own 50% retracement and its own little, kind of launching point and balance area low type spot where buyers can be active. Nasdaq's holding up okay. So in terms of our bias, short term, we know that the sellers have been more dominant, but our intermediate term bias is still going to favor the long side, and there's still potential for buyers to step in here and push the market back up, or just maybe balance in a range. We have the G20 meeting this weekend, so it's less likely that we're going to get huge movement ahead of that. That's a bit of a catalyst here because it affects the whole tariffs and the China trade situation. So right now, I think that the next push down, or even right here at 15 to 18, there is that potential for buyers to still be active, as the Russell is testing its own support at 1515 to 1520 or so. If the S&P is testing one of its own respective areas of support, could be around 2908 to 2910. It could be 2900 to 2903, which is another, good spot for buyers to be active. Or if the market's really bullish, it may not even get to 2900 to 03. So, that's yet to be seen. But the main idea is that, the intermediate term bias is still favoring the long side. This could simply be a pullback after a pretty extended run up. You can see that pattern kind of in play over here, where earlier, we went from this swing low up to this swing high, right? And we got this retracement down to this 23.6% area, and then the market made another swing high. So this was, a signal of strength that the market barely pulled back, and then, started going even higher. Well, technically similar situation could take shape here. Now, we don't have to predict it. We just have to assess the environment for what it is, try to be as objective as possible as we can be, and just be prepared so that in real time, because we're day trading, right? So in real time, if we start to see, let's say, upside momentum, and we start to see broad market strength, and we start to see, Nasdaq running higher and the Russell stopping its downside movement and starting to rally, well, then we shouldn't look at it as, oh, this could just be a little bounce on the day time frame. We have to understand that the market could be putting in a reversal off of a larger time frame zone, which means that if the intraday situation is bullish, we could get a better run up to the upside. Now, if the intraday situation is very bearish, then maybe we have to test a better area of support before buyers step in. But again, this is for preparation. This is not a crystal ball. This is not a prediction of exactly what's going to happen. No one knows what's going to happen. I mean, if I knew what was going to happen, I would never use stops, and I would always, just go full leverage and bet the farm, right? But we all know that no one knows what's going to happen next, and that's where risk management comes into play, and that's why the position sizing and the stop placement, all this stuff really matters. So, that's the environment we're in right now. That's the situation we're dealing with. But as the market pushes lower, we have to be open to that idea of buyers stepping in. And then if they do step in, then we might be able to get a better target off of that intraday long, because the long setup would not simply be a setup based on a 5-minute pattern. It would be a setup that would be in alignment with the pattern on the daily chart. Whenever you're trading a pattern that is not just limited to your little 5-minute chart, but it's part of a larger pattern, that's where you get the best moves. That's where you get the best trades, where your risk is based on the tiny pattern, but your reward or your target is based off the bigger pattern. That's the time where you get those really outsized wins. And anytime you can kind of find that situation where, like for example, even how Mitch traded that little retracement, right? Well, it's a small retracement on a 5-minute chart, but it's part of a larger pattern because it's also a false breakout on the daily, followed by a multi-day balance breakdown below the recent 2 to 3 day range, right? So that short setup is not just a little pullback setup just based on the opening drive or whatever. It is that. That's how he got in, right? But it's also part of the bigger pattern, which can lead to that bigger downside move. And that's where you get those big reward potential trades. So if you keep that one idea in mind, this little thing, this idea, is an amazing strategy on its own. Now, it's a lower frequency strategy, because those situations don't happen as frequently, where you can use a small pattern to trade a big pattern, right? But when they do happen, they make for some excellent risk-reward plays. All right, guys, so that is a wrap for today. Thank you for all the questions. Thank you for attending. I hope you guys are all trading well. We will catch up on the next webinar. Take care, guys. Good night.